If you look at most of the trade examples that are given in trading lessons, you'll notice that people are usually showing off these opportunities that lead to huge profitable moves, because obviously they look more impressive and it makes them look like they're a better trader. But this means that when you start trading, you feel like you should be looking for the same. But smaller profits and short-term moves can have a place in your trading as well, as long as they fulfill important criteria. And I'm going to show you what I mean throughout this video by walking you through a trade example that was taken during the US election week. But first, what are these important criteria? So let's think about what leads to successful trading from a trade point of view, not trading psychology or routines or anything, but from a trade point of view. So we have the trade quality and the trade quantity. Quality can be measured by the expectancy of the trade. This basically means that if you took the same type of trade over and over again, when you calculate the times it loses and the times it profits and sort of combine them, what's the overall contribution to your return? So the higher the expectancy of a trade, the more it's going to contribute to your returns in a positive way. And if the expectancy is negative, it's going to contribute in a negative way because it's going to lead you to losses over the long term. Now, if you want to understand this further and start applying it to your trades, check out the link in the description box to my free training that will walk you through this process. I personally believe it's the most important 1-hour training that any trader can go through, but especially if you're relatively new to trading. Then we have the trade quantity. So if the trade has a positive expectancy, the more often you take those sorts of trades, the more profitable you're going to be over the long term, because each trade, it's almost like a snowflake, like lots of these little snowflakes from these individual positive expectancy trades, and it's the accumulation of them that builds something more significant, a snowman. So in an ideal world, you'd have trades with the highest possible quality that happen really frequently, so high quality, high quantity. But that's not usually the case. Instead, there's usually some sort of trade-off that takes place, because the higher expectancy trades will usually be these bigger market moves that take a while to play out and happen less frequently. You know, you're not going to find huge opportunities every hour, so they're less frequent, they take a while to play out. Whereas the trades that happen more frequently, that sort of happen quicker, are going to be lower expectancy because they're smaller market moves. Therefore, we can think of all possible trades falling somewhere on this chart. And if you want to get the best performance from your trading, you should be looking for trades that fall into either of these areas. Because if the trade falls in this area, you're spending time on opportunities that contribute less to your success than other opportunities would, so you'd be better off going out and finding different sorts of opportunities rather than wasting your time, capital, mental energy on those sorts of opportunities. And this is exactly how I break down my trading. I focus on finding two categories of trades. Either it's going to be these big runaway opportunities that come less frequently, or it's going to be what I call my bread and butter trades, which are these short-term positive expectancy ones. And today we're going to be focusing on that category. So positive expectancy trades that are quick, so don't take much management of the trade, and they're frequent, so they happen more often. But this doesn't mean that I'm just looking for general scalping. In fact, I hate the term scalping. I think it's quite misleading. Instead, I'm looking for a very specific type of situation, a dependable range. The benefit of a range is that you'll often get more than one opportunity from a single range, which means once you've done your analysis, it's not just looking for one entry and then either it's a profit or a loss, but you'll often get more entries from that one piece of analysis. So more bang for your buck. They're dependable, which means that my probability estimates will be more accurate than other situations. They're quick, so they're so short term, so it doesn't take long to be in and out of the trade. And they're relatively easy to manage, which means it takes less mental effort. So it's really like an ideal situation. Now, my trading approach starts with a market selection process, and I always encourage everyone to follow a market selection process because great trades begin with great markets. So market selection is basically a set of analysis steps that I can do very quickly, which allows me to scan through a lot of different markets really efficiently to identify which one is the right one to focus on. Because let's face it, doing full analysis on a market takes time and it takes effort. So I want to make sure that the market I'm focused on and I'm doing that full analysis for is worth spending that much time on. If you spend too much of your trading session analyzing this bunch of different markets, you'll miss opportunities, and when you do have an opportunity, you would have already used a lot of mental energy, And you should be saving that mental energy for when you need it the most, which is when you're entering a trade and managing that trade, not wasting it on fruitless analysis. So in this case, for market selection, since it was the US election week, if I wanted to trade a range, I needed to wait until the conclusion of the election, when we knew who was going to be president, and it needed to be a market that wouldn't be directly impacted by the Federal Reserve monetary policy decision that was coming up shortly after. So I was scanning for a market as efficiently as possible that fulfilled those criteria while also showing consolidation on higher timeframes, ideally with a strong path of resistance on one side of the consolidation. And I'll explain why that's important in just a moment. So this led me to Euro Swiss franc, which fulfilled all of those criteria and seemed to be worth doing further analysis on. We could see the consolidation here on the weekly chart. Now, a lot of traders avoid markets like this that are consolidating because they don't think the conditions are good for trading, since they're looking for these huge runaway opportunities. But when I look at this, I know it's in a range or a value area and could give frequent high dependability setups. Then, if we look at the daily chart, we can see this path of resistance that the consolidation is happening at, and it's happening just below it. So this gives me a directional bias, which basically means that I'll be looking to trade short from the upper side of the range. And there are two reasons for this. Firstly, it means the probability of a reversal at the top of the range is higher than the probability of a reversal at the bottom of the range because of that stronger path of resistance from a dominant time frame. And secondly, it means there's a higher chance of a breakout at the bottom and therefore a further move, which would then mean that I've turned a short-term trade, if I've taken a short from the top of the range, into an even more profitable move if it ends up being a runaway trade. So I'm looking for a range trade, but if it develops into a bigger long-term move, that's only going to serve me better. Now, whenever I'm analyzing a market, the most important thing is to understand the context. A lot of traders just try to identify setups, looking for situations that meet this list of criteria that they've got. But a setup is just for timing the entry. It's letting you know now is the right time to enter because of some shift in activity. But the opportunity itself comes from the context. So the first thing I want to do is understand what's happened so far, starting with the structure. Now, looking at the structure on the daily chart, we can see that we had a long-term bearish trend with sharp legs down, followed by deep pullbacks. Once the trend corrected the entire previous move, so the previous trend, we struggled to create a new low, and we entered into this sort of consolidation. So breaking this level would have been an early indication of a shift to a more bullish situation, because it would be showing us that the underlying dynamics of the market have changed, whereas failing there would show that the underlying dynamics are still bearish. A good way to think about this is to imagine it's like a shop that's increasing or reducing its price and seeing how that affects supply and demand. So if previously the shop was able to raise prices up here and demand was still coming in, the price was able to go higher and higher, but now even at a lower price there isn't the same demand, it tells us something about the state of the market, about demand, where demand's coming in or not. Now, obviously, in the actual markets, it's all about volume and liquidity, so it's a bit more complex than that shop example. But I always think thinking about the shop raising and lowering prices is just a good way to visualize it and to understand why structure is important. So, since the price has failed at this level as a type 3 close, it was clear that we have a strong path of resistance that was limiting any bullish activity, and the underlying dynamics in the market were still not bullish yet. They weren't necessarily bearish, but they're not bullish yet. Now, I know that maybe already that sounds like a lot, but this whole process that we've gone through so far usually just takes me a couple of minutes, maybe even less sometimes, when I'm not having to explain out loud what I'm doing and why, like I'm doing for you now. So don't worry, it is really straightforward. So the market selection process is complete at this point. I've identified this as the market that I want to focus on. So now I'll drop down in timeframes to see what's really going on within that consolidation. And ideally, I'm looking for a range rather than just a standard sideways market. And I differentiate a range as being a sideways market with very clear and dependable upper and lower boundaries, rather than a usual sideways market where the highs and lows are more mixed, but it's just not progressing into a trend. So dropping to the 4-hour time frame, we can see a range within a range within a range. In other words, there are ranges across different structural time horizons. So it's a bit like a Russian doll. And these situations are ideal for short-term trades because it means you can structure a trade on the short time horizon, which means tighter risk, but then be able to restructure the trade after an initial profitable move to benefit from the longer term time horizons as well. And that's perfect because it means tight risk with potentially huge upside. Now, there are three main categories of elements that I'm analysing to understand the context of a market. The first one, which I've already mentioned, is the structure. Then we have the paths of resistance and the microstructure, also known in the Duomo method as the triad of price action. And if you want me to explain the importance of each of these elements and how they contribute to understanding the context, let me know in the comment section down below. If enough people comment, I'll do a video explaining all of it for you. So I added the level here where we can see a clearly defined top of the range. If we look at the short-term structure, we had low conviction bullish structure that then failed to create a new high and went on to break lower, which then meant that there was weakness in the structure. At the time of analysing this, we were now back at the top testing that high. So we would need to break this level to return to bullish structure. But since we know we have another path of resistance from the dominant time frames, like I mentioned earlier, it was telling us that the probabilities would be better than the base rate for a move back down, and then either staying in sideways structure or breaking into bearish structure. And when I say the base rate, I mean the probabilities of a situation if we had no edge. So a 1-to-1 risk-reward situation would have a base rate of 50% for each outcome. A 1-to-3 situation would be 25% and 75% for the outcomes, and so on. So as traders, we can only make money if the probabilities are different to the base rate. If they're just at the base rate, you're going to be at break even all the time over time and probably losing money because of the transaction costs. So my working time frame for this trade, meaning the time frame that I'm going to look for an entry on and I'm going to manage the trade based on, was the 1 hour time frame. And here we can see that the market put in a lot of work at this level before eventually breaking with momentum. So that means there's likely to be a build-up of activity there, which means it's a significant level, a path of resistance, because that's basically what a significant level is. It's a level or an area on the chart where we're expecting a shift in activity, and shifts in activity often happen because of previous activity. So this level went on to become the bottom of the range, which added more confirmation to its importance. And all of this period here was the disruption from the US election. Now, sometimes this sort of activity can be a bit like a reset for the price structure that we've developed up until that point. But in this case, we can see that after all of that disruption, the price continued to respect the upper and lower boundaries of the range. So this was still the value area for the price. Therefore, if the price is approaching the top, we know there's a chance for responsive action, and that's what we're keeping an eye out for. Now, on the morning of election day, we had a few hours of consolidation before we had a sudden break with strong momentum. So this indicated that there's a possible demand area there, which was then confirmed by the later interactions. So for me, this is going to mark the bottom of the range. It's not, precise, but since we have a path of resistance there around the bottom of the range, it makes sense to use that significant level as the guide for where the bottom of the range is. So now we have a good understanding of the context of this market and the different forces at play. This allows us to anticipate the potential outcomes, estimate the probabilities of those outcomes, and therefore determine whether or not there's a viable trade opportunity. But to enter a trade, we also need to get the timing exactly right. And with the Duomo method, we're focused on precision. So let's move on to the entry so you can see how I do that. In this situation, there were two time horizons at play relative to this time frame. The medium term was in bearish structure. A break above this level would signal weakness in the structure, but if that level held, we'd still be overall bearish. So this gives me two key levels. The first is for the break in structure, which is this level, and the second is the start of that trend, which also happens to be the top of the range. Now, usually I'd assess the structure characteristics. That's the speed, length, and depth of pullbacks. But with the disruption from the election, the short-term structure is a bit distorted, so any conclusions from the characteristics would be unreliable, so it's not worth sort of analysing that aspect. But with the shorter-term structure, we put in a higher low and then broke this high to enter into bullish structure. And when that happens, we want to anticipate where the end of that wave may come in. Where is that level where we're going to maybe see a shift in activity that will cause that wave to come to an end? Not necessarily to be the terminal point in that trend, but at least for that wave to come to an end. And in this case, we could do that with a Fibonacci range that had a perfectly confirmed C point, giving us a 161.8 towards the top of the range. That's what we call an invisible level, and then combined with that we have the visible level of the top of the range. So it's an invisible level because it's a projection based on previous movements. Now, looking at the microstructure, the triad of price action, so the trend, momentum, and volume of the recent moves, I had to be cautious about this surging momentum that was moving towards that level, which indicated herd activity, and we only want to trade when there's steady state activity. But the signs were showing that we've probably returned to steady state activity, and a quick look at the volume on the volume profile shows that we were previously seeing responsive action in this area. We can maybe expect the same. Now, these interactions were single confirmations, but that still wasn't enough to enter a trade in this situation. We needed a double confirmation, which we got a short while after with this candle here. In fact, it was a triple confirmation. So we had a type 3 on the previous lower high, showing failure at the level, but without precision. We had a type 3 on the 161.8, again showing failure, but not precision. Then we had a type 1 failure at the top of the range, which is an indication of precision, as well as obviously being failure. Now, along with this, we also already had confirmations on the 4-hour and the daily timeframes, although arguably the 4-hour confirmation was just the same as the 1 hour because there were similar levels. So the potential outcomes here were simple. For the first order outcomes, we could either break out of the top of the range and therefore change the context of the market, or we'd fail here and return to the B point of the confirmed Fibonacci range, which is my TMP level, trade move potential level. I won't explain what TMP is in this video, but you can basically think of this point as being the first decision point. So it's not a profit target, it's a decision point. So we can now think about what these potential outcomes will mean for the context of the market, and this is essentially how we structure and plan our trade opportunity. So if this first order outcome of breaking the top of the range did happen, then the probability of profitable outcomes would have fallen enough to no longer make the opportunity viable from a trade expectancy point of view, because then the paths of resistance are on the wrong side of the price, and it's also showing that we've broken out of the range, maybe switching into bullish structure, and so on. So with that in mind, to protect against the negative first order outcome, my stop loss would be above these wicks here. So it's far enough that the price could move up and still fail in that area, but it means that if it goes too far, then it's getting us out before the breakout continues to happen, and therefore we're cutting our losses early. In terms of the profitable potential outcome, after my decision point at TMP, we then have second order outcomes. So one of these second order outcomes would be a return to the top of the range, and at that point would be at break even. So any of the move from the decision point all the way up to there would still be in profit. And the other second order outcome would be a break to the bottom of the range, which, as I mentioned earlier, we already identified as being this zone here. So for the probabilities of these outcomes, that would give us a base rate, so the percentages if we had no edge, of 57% for the negative outcome and 43% for the positive outcome. But when we consider all of the context factors that I've just been explaining to you throughout this video, we can make adjustments to these probabilities, which gives us an end estimated probability of 47% for the negative outcome and 53% for the positive outcome, just based on the first order outcomes. So with these estimated probabilities, we can now calculate the trade expectancy based on this formula here. So the expectancy for this opportunity was positive. My probability estimates assume that regardless of whether this individual trade ends up being a profit or a loss, if I took this type of opportunity over and over again, it would be profitable overall due to those probabilities. Now, based on the first order outcomes alone, the expectancy wasn't far enough above my margin of error for me to be able to take the trade. But when I consider the second order outcomes, it pushes that expectancy up even more and makes this a viable trade opportunity. So based on the expectancy, I then choose the position size, which would be relatively low for this one, and it was just 0.7% at risk. Now, as I mentioned earlier, I know all of this can sound like it's a lot of work and it's quite complex when it's being explained in this much detail. But really, once you learn these skills, it becomes much more automatic, and this whole process can be done in a matter of minutes without having to spend that much mental energy. It's just like any other complex skill. It feels like a lot of work at first, and then as you get better and better, it just becomes more automatic, and that's the case here as well. You know, a lot of traders oversimplify the markets rather than trying to understand the context and the logic of the situation. But in many cases, this just leads them to trading based on luck without realizing it. Whereas the process that we follow with the Duomo method allows you to measure your skill level objectively so that we don't rely on luck. And in one of our next videos, I'll show you what I mean with that, how we can measure this skill level objectively, and why this approach that I'm explaining to you is therefore much better than just, following some set of criteria and hoping for the best. Okay, so the important question now, what happened next? Well, after entering the trade, the price headed directly to the first decision point. So at this point, there was potential for this to be a higher low and lead to the next wave going through the top of the range and continuing in bullish structure. Therefore, the stop loss could be dropped slightly to be based on these highs, as breaking these highs would significantly change the context and therefore increase the probability of a negative move. Now, I have an important rule that I always try and stick to, and I try to encourage other traders to stick with this rule as well. And the rule is, whenever you reach the decision point, whether you decide to take an action or you decide that no action is needed, you should always at that point in time know where your next decision points are going to be. This avoids you being reactive to every price move that happens and ensures that you're only going to make decisions when it's logical to do so. Because traders get too reactive, your emotions get caught up and you want to bank your profit when you have it, and then you end up seeing the price run away into more profit and you could have stayed in it if you made a more logical decision. So the next decision points at this point in time, it was going to be at the bottom of the range or obviously breaking back to the top of the range. And we actually reached the bottom of the range the next day after some overnight consolidation. We then broke through the zone, but then we came back through it and tested it from the other side, which meant we had the path of resistance below the price, and it was also around the point of control of the value area. So since we were so close to the end of the week at that point, and this wasn't a huge opportunity with a huge profit built up, it made more sense to be neutral for the weekend, to be out of the trade. And this is generally what I like to do with most of my trades, unless it's like a more long-term one, like trades in the other category that I'll explain to you another time. I prefer to be neutral and not take the risk of something disruptive happening on Saturday or Sunday when the markets are closed and then gapping open for the start of the next week. So that was a logical exit point for this trade. And if it wasn't for the weekend, it would have made sense to maybe take a partial profit and leave the rest open for a continuation of that bearish structure, since that's what the context was showing us at that time. Now, if you want to see more trades like this and to get more insights from me, I have a mailing list that you'll see linked below in the description box, and I send trading lessons and insights to over 20,000 traders each week, including my end of week email, which is called Nicholas Notes, I know, original. And in that email, I always share a trade of the week, and this trade that I've just walked you through was actually in the previous one. So if you want to get access to all of this, you can sign up in the description box, but you also get access if you sign up for the free training that I mentioned earlier. So you might as well go and do that anyway, then you get an extra thing there. Thanks for watching. See you soon.